When you're getting into the infinite banking concept, the money multiplier method, you need to be in this for the long haul. This is not a get rich quick kind of deal. This is a lifestyle. It's a process that you're adding to your financial life, and wealth is truly built. Hello, Money Multipliers, and welcome back to the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? So, hi guys, I'm back. I know I had to take the summer months off, and let me tell you, I needed it. I feel refreshed. I feel back on top of my game. But more importantly, I'm excited to get back in front of the mic because while I was away, it seems like y'all just went off in your own different areas, okay? We need to bring it back to center, and we need to understand the fundamentals of the infinite banking concept. Now, in this episode, I'm going to get into a lot of the naysayers, what they got to say about IBC. And I'm going to get into different strategies. I'm going to show you how I implement my policies, my banking system with the private lending that I do. And it doesn't matter what you invest in. Invest in the things that you like, know, and understand. But really, we need to have a place to warehouse our money to safely and smartly go and buy the things that we're buying in life, the products, the goods, the services, and this can include investments. So what really got me thinking about today's episode, and I have my little sticky note here because I've been writing some things down over the course of this summer, and I've had some, lack of better words, issues come up. All right, about some people who got away from their root of why they started implementing this in the first place. And then, getting into folks who will get in their ear and they'll listen to all that noise of what's going out there. So we really need to come back down to the fundamentals of why we do this. And a big one that always comes about is, well, I think it would be smarter if I go and just take this money, surrender my policy, and then go invest it into this real estate venture, this crypto, this stock, this option that I'm looking to purchase. Or, hey, I don't think I'm going to do this policy because I got my friend who's a life insurance agent and they said they could give me better rates. Oh my gosh, that one I could go on a whole spiel on. And then, my people who are talking with their financial advisors who are saying, hey, it would make more sense if I just buy term and invest the difference. I should just take all of this money and go and put it directly into the stock market because the stock market is averaging 6 to 8%. First of all, it's a whole other episode that we can talk about is your average versus actual rates of return. Y'all need to understand average versus actual. So that's what really got me into this whole episode, talking about getting back to the basics and just understanding why you even started doing this in the first place. And before I get into it, there was one thing that one gentleman said to me, and he's been around. I mean, he's got 6 policies. He's been doing this since 2017. And he says, hey, I haven't been using my cash values, and so my policy is not performing how it should be. And in my mind, I'm thinking, no, you're fine. Because y'all, look, at the end of the day, all the infinite banking concept talks about is us having a place to warehouse our money so that I can safely harbor it. I can then use it, still have accessibility, still have liquidity to that money, so that when a time does appear that I need to go pay my taxes, buy this vacation, send my kids to college, buy the car, buy the airplane, buy the boat, buy the investment, literally whatever it is, I do not care. You now have a place of where you're warehousing the money, where you are in total ownership and control of those dollars. So even if you're the type of person that you're thinking to yourself, well, this policy is not performing how it should be because I'm not using it, you're fine. I mean, you still have your guaranteed interest, you still have your dividends, and you still have accessibility to the cash value that's inside of that policy, and you still got this guaranteed death benefit that's going to pay out when the time happens and Jesus calls you home saying, hey, we want you back up here. So yes, I do agree that you can go and use the policy cash values to go put your little green men to work. It's even harder for you. But even if you're not using your cash values and you're just using this as a system to warehouse the money that you have to protect it, grow tax-free governments out of our hair, then you're fine, okay? So just a little PSA for the start here of the video. Before I get into it today too, I'm excited about this because look right behind me, all right, for all of my folks watching on YouTube. And I do think if you are listening to this on the podcast platforms, I would maybe switch this over to the Money Multiplier YouTube channel because I have some visuals that we're going to be going through together. However, we do have the upcoming Money Multiplier Mastermind event happening in Denver, Colorado this year. Yes, my West Coast people, I hear you. I know you want us to come out closer to you. Last year I held it in Nashville, and honestly, the only reason I held it in Nashville is because I love Nashville, but I'm hearing you, and so that's why I relocated it to Denver, Colorado for this year of 2025. So it's October 9, 10, and 11. You can go snag your tickets on themoneymultiplier.com/mastermind 2025. So stick around to the end of the episode, and actually I have a little bonus for y'all as well. Okay, let's get into it. So, my students, welcome back to class. It was a wonderful summer break, but we're going to dive headfirst into Nelson's book. So everybody get your books ready. Becoming Your Own Banker by R. Nelson Nash. You need to have this handy. You need to keep rereading it. I would suggest at least one time every single year. And remember, if you got a little ADD like myself, it also comes with the 2 hours of audio. I actually remember this one time that Pops and I got back home from an infinite banking concepts practitioner think tank event that the Nelson Nash Institute puts on every year. And we fly home from Birmingham, land in Orlando, and as we're driving back home to Daytona Beach, Dad's like, you know, let's put on Nelson's audio tape. I'm like, Dad, I just spent 4 days talking about Nelson, being with all of my colleagues. We really gonna sit here and listen to Nelson again? But honestly, I'm very grateful that, you know, he keeps reestablishing the importance of going back to the basics. So right here, if I turn around, this is a chapter in Nelson's book, and I want to say it's on page 69, okay? And this is talking about, in quotes, but I can get a higher rate of return. Okay, a lot of my investors, specifically when I'm speaking and talking at real estate events, a lot of them ask me, they say, well, Hannah, you know, if I implement this concept, how would this be better for me? Because in year one, when I put money inside of my policy, I don't have access to that same dollar that I put in that first year. And they're right, we don't have access to dollar for dollar quite yet. But that's why I use my analogy of starting a policy is almost like starting a business from scratch. I'll get into that. But this is all about the tortoise and the hare story, okay? I use this analogy a lot, and I really reference that story a lot because you're right. If you just take $100,000 and go place it into a 12% investment, and I use my policy, I put $100,000 in there, I'm only going to have access to $90,000. You're investing $100,000 directly into that investment straight away, and I only have $90,000 that I'm investing into this fund, this investment, let's say for 12%. So you're correct. You're going to be ahead of me in the early years. You are the hare, but you know what? I'm the tortoise. I'm the tortoise. I'm going to be a little bit slower than you until about year 3, year 4. But after the 4th year, I'm going to catch up to you, and I'm going to beat you, and I'm going to win this race all day, every day, and you're never going to catch up to me. So let's talk about it. Let's just go back to the basics of Nelson's book. He says, when first exposed to the rationale of the infinite banking concept, a person will almost always think and often voice the thought, but I can get a higher rate of return by investing in blank. Private lending, crypto, stock option trading, gold, silver, whatever it is. Unfortunately, that person has not understood the message. We are not addressing the yield of an investment. We are discussing how you finance anything that you buy. It is always better to finance it through your own banking system than out of your pocket. To demonstrate this principle, suppose that A, my individual A, let's give him a name. Let's call him Allison. Allison invests $100,000 for 1 year and earns 20%. So her gross yield is $20,000, but we got to take into consideration the taxes on that money. So let's say that she's taxed at the 30% tax bracket. So $20,000, 30% of that is $6,000. I got to subtract my 6, and now $14,000 is my net yield. Suppose B, let's give B a name. B is going to be Brittany. Suppose Brittany builds cash value of $100,000 in her own infinite banking concept, dividend paying whole life insurance policy, then plans to borrow from their system for 8% and then makes the same investment as Allison above. The results are like this. Her gross yield is $20,000 less the interest paid to her banking system. 8% would be $8,000. Her taxable gain is $12,000, and I have to subtract out the 30% of the taxes that I got to pay on the earned income that I made from that investment, which is $3,600. The net yield is $8,400. Hi, Money Multipliers. Pardon the interruption. If it's been a while or if you've never seen my presentation on the infinite banking concept, what I like to call the Money Multiplier method, click this link right here, themoneymultiplier.com/presentation. I'm telling you, 90 minutes of your time can completely change your family's financial future. All right, let's get back to the episode. But is bold and in all capitalized. But in this case, you must remember who the characters are in the play. Brittany also owns the policy to which interest is paid and earns the $8,000 on a non-tax basis. So the total results are like this. Net yield from investment is $8,400. The net yield from paying the banking system is $8,000. So my total yield is $16,400 compared to Allison, who made $14,000. Brittany's coming on top with $2,400 more than what Allison did. Now, what Nelson is talking about here is the interest that was paid into the policy is them paying additional paid up addition premium. So when you truly establish and are playing honest banker with yourself, that extra interest that you earn goes back inside of your policy as more paid up addition premium that then is being grown on a tax-free basis. And here's a little insider scoop, okay, why this is all tax-free. Because loans out of your policy, when it's being used for a business expense, that loan interest that you pay yourself back, that can be counted as a tax deduction come tax time. And I'm whispering that because I'm not a tax professional, and go talk to your CPAs about this. This is not financial advice. This is just financial literacy. Welcome to class. So Nelson continues on. This principle applies to any investment that you might make, so there is no way that a person can get a higher rate of return by ignoring the banking process. There is a delay in time while getting the banking system established, but once that is done, it is a one-time only event. Anytime a person starts up a new business, there is a delay in time before profitability commences. When a life insurance policy is created, that is equivalent of starting a business that never existed before, and the same phenomenon is inevitable. Inevitable. That's a hard word. So what I mean by this, starting a policy is almost like starting a business from scratch. Because if I put $1 into my new business or the policy, I'm not going to have access to that same dollar. Let's say I put $1 into the business and my profits that year are 60 cents. Okay, I know, I get it. I just started this new business. There's an overhead cost, there's marketing expenses, there's blah, 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 right? Year 2, I put $1 into that business or the policy, and now my profits are 75 cents for every dollar I put in. Okay, I get it. I'm not breaking even yet, but I'm trending in the correct direction. Year 3, I put $1 into that business, the policy, and now my profits are 95 cents. I'm almost there. Year 4, I put $1 into this business or the policy, and now my profits are breaking even. I have that same dollar accessibility that I just put into as my policy premium. That's my break even year. That's my dollar for dollar year. But then this is when the fun starts happening. Year 5, I put $1 into my business or the policy, and now my profit growth is $1.05. You see where I'm going with this? Year 6, I put $1 into the business. Now my profits are $1.10. And the question that Nelson would always ask is, if you knew guaranteed that a business were to operate this way, how many of these businesses do you want in your lifetime? Hopefully the answer is as many as I can get. So do you see why I own 8 of my own policies? I buy a new one every 24 months, and my dad has freaking 28 of these stupid policies? Because the thing is that you guys go out there and you buy these other businesses, or maybe you are a private equity firm, or you're into business acquisitions and you want to buy these profitable businesses, but those are not guaranteed to perform that way. There's a whole bunch of subjects in there that's going to alter the profits of that business. How's the economy doing? How's the interest rate doing? How many customers did I bring in this month? You know? How's the value of my product being sold? Did I decrease the value of it? Did I increase it? You know, you have all these different variables that are in play there. In my business, aka my whole life policies, there's no variables. It's guaranteed. I have a guaranteed appreciating asset vehicle that is always going to perform this way. No ifs, ands, or buts, not based on markets, government intervention, or the Fed and what the Fed decides to do. I don't know if I want to get political here, but let me just say I'm kind of impressed with what's going on in the world right now and how Trump is talking to Powell, so we'll see kind of what happens. But let's move on. I want to show you how we're really doing this in real life now, okay? This right here is a real life deal that came available on the Private Money Club. Now, the Private Money Club, if y'all aren't aware about it, it's what Chris Noggle, my business partner, likes to say. It's a dating site for money. So if you go to privatemoneyclub.com/Hannah, Hannah spelled the same way as forwards and backwards, you can get actually a discount code to get involved in the masterminds and the deals that are being posted up there. So Private Money Club is like a match.com between borrowers and lenders. It's really people who have money looking to go and put it to work for them. And for my folks who need the money because they have deals, fix and flips, they need down payments, whatever it is, they're in the market and they're looking for private lenders to help them succeed in their investments that they're looking to do. And a question I get a lot too, for people who are not maybe familiar with private money is, well, why would someone pay this high of interest to somebody? Well, the reason being is I don't ask for your financials. I'm not going to make you wait months and months and months to close on the deal. I can close literally the next 2 days if you want to, right? So that's kind of why people go the private money route, is because they don't want the headache of what the banks will make them go through. So this was a deal that was posted up on the Private Money Club, and it's a 15% ROI on the first lien position. So here's my other advice, and these are just the rules that I personally follow for myself, but I want to have a deal that's only in the first position. And why do I want it in the first position? Well, because if you're not first, you're last, all right? Always keep that in mind. I've never lost money on a real estate investment deal because I've always been in the first position. And this means that if that borrower stops paying you, you filed that lien with the county that you can go in and you can foreclose on them just like any regular bank would. So now I'm protecting myself and I'm protecting my principal of the investment, because now I have this collateral of this hard asset that's equal to, if not more, the principal of the amount that I've loaned out to them. And yeah, I don't want my people to forfeit on their loans. I mean, that's just an extra thing I gotta do, and I got too much shit going on in my life, right? I don't want to go and foreclose on you. I don't want to go list this property or go find tenants. But the good news is I am in control. I am the banker. So then I have my return of my principal, and then I can go do whatever I want with that property, okay? So here, this is how the money is going to flow in and out of the policy. Right? You have your premium deposits that are going to go in, and inside of your whole life policy, there's going to be cash value in there. What we're going to do is take the money out of our whole life policy in the form of a loan, and it's going to go into our segregated checking account. Let's break down those two real quick. For my people, this is like the first time you're ever hearing about this stuff. First of all, if this is the first time you're ever hearing about this stuff, you need to pause this video. You need to go to the moneymultiplier.com/presentation, click on the Watch Brent Now button, and then you'll be introduced to my father, Brent Kessler. You'll hear all about his story and the fundamentals about the infinite banking concepts, all right? The what, the why, the how, we're all doing this. So just quick recap. Why are we taking out loans and why are we not withdrawing the money? Because I want to take out a policy loan because now I'm not interrupting the compounding interest that's happening inside of my policy by doing so. See, if I were to just go in there and withdraw the money out, whether it's my policy or my checking or savings account, that money was inside of my pocket earning me interest, and now when I go and just withdraw it out and go place it to work for me in this investment, I'm now no longer earning interest in my pocket. I'm only earning interest in one place. So the reason we take out policy loans is because now I'm not interrupting the compounding interest of what's happening in my policy. Really, what's going on, and logistically, we are putting our death benefit up for collateral and we're taking a loan from the general funds of the insurance company. I'm putting the death benefit up for collateral, I'm borrowing from their pool of funds, and I'm using their money in the real world, and that's how and why my money still remains in the policy to grow and compound as if it wasn't even touched. I mean, is that cool or cool? I don't know of any other vehicle on the planet that allows you to do this stuff. So that's policy loans. Let's talk about the segregated checking account. Now, this is not something that you have to do. I would encourage you to do it because it just keeps things cleaner in your books, all right? Any money that comes out of your policy is tax-free dollars to you. So I just have mine go into a separate segregated checking account because then come around tax time, it's easy to identify what's taxable income and what's not. My CPA is not going to be mad at me, right? So all money that comes out of your policy is tax-free to you. So when I take my loan money out, now it goes into my segregated account, and then I'm going to deploy it into this private lending deal. Then my gains are going to come back to me on that 12% interest. It's going to go back inside of my segregated account, and then I'm going to go and put my policy money back inside of my policy. So let's take a look here at exactly what happens, and let's just kind of debrief here on how this policy is designed. There's a $100,000 dump in going in the policy the first year, and we have $12,000 annual premiums. Now, you can do this. You can actually design a policy year one to do this dump in, and then year two, drop it down to a lower ongoing, more comfortable premium amount. A lot of my investors like to do this, or my folks who have like a large savings account on the side, not doing anything. And they come to me and they say, hey, Hannah, I got this 100 grand here. I want to flow it through the policy because I understand the importance of doing so. But I know I'm not going to do 100,000 every single year. I feel more comfortable doing 1,000 a month or 12,000 a year. So you can design a policy year one to do that dump in, and then year two, drop it down to the lower ongoing, more comfortable premium amount. Now, why specifically my investors like this is because when you dump that money in, I tell you conservatively that you have access to 90% of that dump in money immediately. And my definition of immediately is within 30 days. So they have $100,000 that's going into the policy the first year. Then they have this $12,000 premium. There's 50% go into the paid up additions, 50% go into the base, and then there is a term rider on this policy. Now, I actually just gave the same presentation to a group of real estate investors, and I didn't go as deep as I would have liked to just because of the time that I had, but I'm going to go deep with y'all here today. So, how do you know that a policy is built specifically for high immediate cash value is because there will be two moving parts. There's going to be what's called the base premium, and there's going to be what's called your paid up addition premium, your paid up addition riders. We'll call it PUA for short around here, but just know PUA stands for paid up additions. And here's the best way I like to describe this. If you have ever seen a space shuttle take off into space, all right? Think about the base of that rocket ship. That's your base premium. And then you have these two booster rockets that are attached onto the side. Those are your paid up additions. Now, why we have the booster rockets is because, well, that's what gets our rocket ship out of the sky and out of the atmosphere. In the policy world, that's how and why we have cash value available to us year one, month one. So your booster rockets, the paid up additions, that's really why we have the cash value made available to us immediately. So to get specific, we have $4,800 going towards our paid up additions. But you know this $100,000 dump in that we put in the policy year one, all of that goes into the paid up edition premium. You'll notice as well that there's $1,000, we'll call it $1,200. $1,200 a year is going towards the term rider. Well, Hannah, why do we want term? Well, I thought I didn't want term. Term is like renting insurance. I really don't want the term. It's just renting me this death benefit for that set amount of time. But here's why we really need it. In the policy to support our MEC limits, okay? MEC stands for Modified Endowment Contract. MEC, Modified Endowment Contract. And you don't gotta memorize that, just understand MEC means no. We do not want a MEC within our policy. And how I want you to picture it, it's like an imaginary line inside of the policy. And what we don't want to do is we don't want to overstuff the policy to go over that imaginary line. Because if we do, the government now is going to start looking at your policy like it's an investment rather than an insurance contract. And then now they're going to start taxing us on it. And we don't want that. We want to keep all the tax-free growth and benefits that come within the policy. So what the term rider does, and I should say this first, your death benefit and the MEC limit play hand in hand together. So what the term rider does is it manipulates that MEC limit or the death benefit to be high enough so that we can funnel in all of this extra cash and still have the tax-free growth of what's happening inside of your policy. So if you do have to have a term rider on the policy, this is just my personal opinion, I turn off that term rider as soon as I can, which happens anywhere from year 7 to year 10, depending on the insurance company. And the reason being is just because if I can use this $1,200 a year and go and place it into something that actually builds me wealth, builds me cash value, instead of just renting a death benefit for that set amount of time, that's what I would personally do, because really the $1,200 a month is just going towards this renting death benefit that hopefully we'll never see, because the only time you'll ever see that death benefit is if you actually graduate or die within those term years, the 7 to 10 years, depending on that insurance company. So high level how the policy is designed, okay? Now, this is based on a whole life policy with a mutually owned insurance company, and there is a chronic and terminal illness rider on the policy. I'll talk about terminal and chronic illness here quickly, just because, you know, I know you folks have been around the campfire for a while, but you can go and explore this within the video library on the moneymultiplier.com as well. I get even deeper into it. But there are terminal and chronic illness riders on the policy, meaning that if you ever come into a terminal illness, meaning less than 12 months to live, or a chronic illness, meaning you can't perform 2 of the 6 daily activities of living, the insurance company will actually start paying out that death benefit early to you to help cover for the medical costs, the assisted living, etc., etc. But just know this is not true long-term care, and if you're looking for long-term care, I should probably do an episode on that here soon. I made my parents actually go and get that. You've been hearing the stories if you've been following me for a while about what's going on with my grandparents right now. But if you're really looking for true long-term care, I would go get an asset-based long-term care policy from One America specifically to have the continuation of benefits, because what's going to happen is that when the death benefit runs out, and if you're still here, you need the care and the monies, there's not going to be any money left to give. Now you have no death benefit, and then you're kind of SOL, right? So just know it is a benefit of the policy. It's a free rider, so I added on to all policies. Why not? But it's not true long-term care in the traditional sense, okay? I just want to make that clear. So here is really my policy illustration, and I want to break this one down. On the left-hand side, this is just time, year 1 to year 15, and then you have age, and then you have your annual premium. I feel like I should pause here and just talk about age for a second. I'm not going to get into the example that I normally like to use when I'm teaching this, but just know that age only affects your death benefit. Age does not affect the cash and the cash accumulation that's happening inside of your policy. And I want to drive that home because I still get this. Even when I say this from stage, these exact words, I want to drive this home because I'm going to get done here today and somebody's going to come up to me and say, Hannah, that information was so powerful, so cool, but I'm too old to do this. No, you're not. Just because you're older means you're going to have a lesser death benefit compared to me, someone who's 26 years old, than you who's 72. But if we put the same premium in our policies, the cash is going to be the same. Okay, so I want to drive that one home because seriously, someone's going to email me later on. I get a lot of emails from this podcast show, and y'all are saying, Hannah, this is so cool, but I want to put this policy on my daughter or my granddaughter because the premiums will be cheaper. Yeah, shut up. You're not listening to me. Sorry, this is one of my little pet peeves. You really don't listen to me then. Because age only affects the death benefit. And if you want my true opinion, ensure the matriarch and the patriarch of the family first, because in the downline, in the history of it all, mom and dad are supposed to pass before the children, and I want to see that death benefit legacy get paid out to them. But again, that's a whole episode we can do on later. So now we have our annual premiums, $112,000 going into our policy. Then we have year 2, 12,000 premiums, and then actually it drops off later down the road. And the reason that the premiums drop off is because that term rider is now dropping off the policy in year 8. You have your guaranteed cash value and your guaranteed death benefits. Because remember, there's a guaranteed interest rate that the insurance company has to pay us and a guaranteed death benefit. So there's guaranteed values inside of this policy. It's an appreciating asset. And you'll notice when you're looking at your policy illustration, there's a guaranteed side and there's a non-guaranteed side. The only difference between guaranteed and non-guaranteed is the projected dividend. Projected dividend is the only difference between these. I'm going to use this real quick. Let's see if I can mark it up. Look right there. I love this new interactive TV, okay? So projected dividend is the only difference between guaranteed side and non-guaranteed side. So if I do incorporate my dividends, because yes, I can't sit here and promise you dividends inside your policy contract because dividends are not contractually guaranteed, but with all the 6 companies I personally do business with, dividends have been paying out for over 120 plus consecutive years. So it's a pretty strong chance that they'll kind of pay out those dividends, right? So if I look here, what I really want y'all to look at is this projected cash value growth per year. This is the cash value increase year after year. So year 1, I put in 112, and I don't have access to the same 112 by the end of the year. I only have 103,000. But remember when I said the policy is like starting a business from scratch? So we get that. Year 1, I understand I'm not going to make profits quite yet. Year 2, I put in 12,000. Now my cash value growth is 13,323. I'm actually making a little bit of profit this year. Look, year 3, I put in 12,000. Now my cash value profit is 14,000 and some change. Year 4, I put in 12. Now my cash value grew by 14,900. You see what I'm talking about with the uninterrupted compounding interest? And then if you just keep going down, you can see how it grows year after year after year. And put a pause on this video. Look at this spreadsheet here. I'll take a quick little smile here. But you can see how it grows year after year after year with the uninterrupted compounding interest. And not to get cheesy on y'all, but this is what Albert Einstein's talking about. Compound interest is the 8th wonder of the world. Those who understand it earn it, and those who don't pay it. And so what would you rather be doing, earning it or paying it? So let's get into the example. in year one, if I am going to do this private lending deal using my policy, I am using the approach of this lending deal is going to make me 12% annual returns, and I'm using the equation of 5% policy loan interest. So my dump-in goes inside of my policy, and I have my $12,000 premium deposits, okay? Then, when my 112 goes in, I immediately have 93.3 as cash value to use. I'm going to take this 93 out in the form of a loan, and it's going to go into my segregated checking account. From my segregated checking account, I'm now going to take this money and then go fund my private lending deal. I give them the 93,308. It's out there, it's working, I'm collecting my monthly interest checks, and that's personally what I like to do. A lot of people have asked me as well. I only invest in things that cash flow monthly because I'm trying to increase my monthly passive income, but I know some people have different goals and different things that they want to do within their investments, and that's fine, but this is just me personally. I like the monthly cash flow. And when that happens at the end of the year, I created profits of $11,165. That $11,165 comes back to my bank account, but I have to pay my policy loan interest of 5%, which is $4,600. Subtract the $4,600 for a total of $6,513. That was my true net cash that I made in year one. So if I look up here in my total summary, my cumulative injected is $112,000. My net benefit is $109,888. And my net benefit is the remaining cash value, the investment capital, and the gain that year minus my policy loan interest. So that's how I came up to the 109. I still have my $1.7 million death benefit, but look here at my cumulative returns. I'm in the negative the first year. Hannah, why in the hell would I do this? That's stupid. Why wouldn't I just go take this money and invest it directly? But wait, there's more. This is my tortoise. Remember that. This is my tortoise. So, if I go back, and I want to bring up year two now. Year two, I'm going to practice the same thing. Year two, my premium goes inside of my policy. I have a $12,000 premium that goes in. And when that goes in, I have a total of $105,000 of cash value that's in the policy. I take out the growth that year. I didn't pay back my policy loans year one. All I did was I paid my out-of-pocket loan interest. So when I put deposit in 12, my cash value grows by 11.9. I'm going to take out the 11.9 plus the 6,500 of my net profits from last year for a total of 18.5 that I'm going to add to my lending portfolio. So now in total, I have $111,000 that's out there working at 12% for me. Now remember, I'm double dipping on my money. I got this out here working at 12%, but I have all of this working in here at a guaranteed interest rate and dividend of no less than 5%. Then at the end of the year, I have 13.3 is my gross gains from my lending deal. I take the 13.3, I pay it back, it comes back to me inside of my checking account, but I got to account for the policy loan interest that I have to pay. When I pay that policy loan interest of $5,200, my net gains is $8,133. So if I look here at my summary, my cumulative injection is 124. I have a net benefit of 134. My death benefit still remains at 1.7. And now my cumulative return is a little less than 6%. Hannah, why would I do that? That's so stupid. Why would I do that? Aha, but wait, there's more. We're only in year 2 of the policy, okay? Let's go into year 3. Year 3, I'm gonna do the same exact thing. I am going to use this policy for another private lending deal. I'm gonna do a different color now. Let's do purple. Purple's kind of cute. Okay. I put in my premium deposit of $12,000. When I pay that premium, my total cash bucket now is $117,000 and some change. I'm gonna take out the growth in year 3. I put in 12, and my growth that year is $12,600. What's that rate of return, investors? That's just happening within inside of my policy, not talking about what I'm doing outside my policy with it. So I take that 12,600, it goes into my segregated account. I'm going to take the 12,600 and add it to my net gains of last year for a total of $20,819. I'm going to take the $28,19 and add it to my total lending portfolio for a total of $132 that's loaned out there in working capital, earning me 12%. In an investment, remember, your policy is not your investment. Those other things are your investments because the policy does not have risk. An investment, in my definition, involves risk. It can go up in value, it can go down in value, and it involves some form of risk. Your policy has no risk. I will say this, actually there's one risk, and the biggest risk factor is you and how you use your policy. So now, when that 132 is out there working at 12% interest, at the end of the year, my total gross gains is $15,883. That $15,800 is going to come back to me, and I'm going to pay my policy loan interest of $5,800. So I have a total of net gains of $9,998. Let's see what happened. Cumulative injection is 136. My net benefit is 155. My remaining death benefit still at 1.7, and now my cumulative return is 14% plus. Oh, I'm a tortoise. I'm now beating you. I told you, just wait, there's more. Let's even fast forward, because let's go to year 10. I want to go to year 10 now. Because let's just say I keep rinse and repeating this whole same process, and I want to see what happens over the course of 10 years. Because time's going to keep passing, right, y'all? I mean, no one can control time. We can all control money. We can all make more money. We can all lose more money. But we cannot control the only resource of time that we have here. So if I'm going to do this over the 10 years, I want to see what happens. I put in my premium of $10,008 because remember, the term rider dropped off. I'm no longer putting in 12. I'm now putting in $10,800. That went in and I have a total cash value of $230,000. My growth that year is $18,400. You put $10 into the policy and your cash value just grew by $18. What's the rate of return on that? Is that almost 80%? Not me just saying that, that's coming directly from the policy illustration. So take that $18,400, I'm going to add it to my net gains of last year for a total of $46,937 that's going to be added to my total lending portfolio, which is $372,000 now. When that $372 is out there working at 12%, I have $44,670 that's coming back by the end of the year as my gross gains. The 44 comes back to me, I gotta subtract my policy loan interest of 11,500, so that means my total net gains is $33,168. Let's take a look at the snapshot. Your cumulative injection is $216. Your net benefit is $430. And just a reminder, our net benefit is the remaining cash value, the investment capital, and the gains you made that year minus your policy loan interest. So your remaining death benefit now is $386. And remember, it dropped because we dropped off the term rider, and it's also dropped because you're taking out the policy loans and you're not paying them back. So that's just what's left over after you've taken out your policy loans and after the term rider dropped off. And let's be real, do you really want to leave money to your ungrateful children? Probably not, right? My cumulative return now is 99.15%. How do you like doing lending my way? Yes, it takes time. This is not a get-rich-quick kind of deal. This is a lifestyle. It's a process that you're adding to your financial life. And wealth is truly built. This is not just a get-rich-quick kind of ordeal that you can just do for a few years and then quit after that. If you're saying you want to start a policy and then stop it after 5 years, I won't even allow you to start your policy because you're just going to shoot yourself in the foot and you're going to be out some money. You don't want to do that. When you're getting into the infinite banking concept, the money multiplier method, you need to be in this for the long haul, okay? No short-term thinking. And I know y'all think you're long-term thinkers, but you tend to get hung up in short-term thinking. And that's why I do these podcasts. That's why I sit down and I talk to y'all one-on-one so that you can really understand the fundamentals of why you even started this in the first place. Because I get it, you know, you're not in this day in and day out like I am. And sometimes you kind of forget the specific details and you listen to all that noise that's going on out there in the world. So I get what's happening, but you gotta also take your own responsibility for your money and what you're truly doing within your financial life. Because honestly, if you're not going to take the ownership over your financial life, who's gonna do it for you? Your financial advisor who just tries to collect the 1% and 2% on you? Seriously, who's gonna take control of it? If you don't care about your financial life, no one else is gonna care about it more than what you do. So this is the and asset, y'all. This is not an either or. This is not me saying, hey, go put your money into a policy or go put it into this real estate investment deal. This is your and asset. I'm gonna run my money through the policy first and then I'll go take it out and go and invest it somewhere. So stop leaking the money out of your hands and out of your family. You got a leaky bucket there. And what you need to do is you need to close the leaky bucket. And how we do that is by incorporating us being our own bankers. Because remember, and I'll end on this note because I know this was kind of a long episode, but you finance every single transaction that you buy. You either give up the interest you could have earned on the money, aka paying cash with it, or you pay out the interest to other people, bank financing it. And we think that there's no other way to conduct our banking business. The reason I'm doing this is because now I'm closing the gap and I'm no longer losing out on the future interest or what is called the opportunity cost of your money, because you're running it through the policy first and you're utilizing the leverage of uninterrupted compounding interest and these stable, mutually owned insurance companies that you are in part ownership of. So hopefully this was enlightening. Hopefully this kind of shows you a little bit about why I do the investments that I do and how I'm doing them. Up to date, I'm actually gonna probably next episode or the episode after, I will post out a passive income report of my own portfolio of what I have going on. I noticed that a lot of y'all love that because at the Nashville Mastermind last year, my dad actually got up there and showed all of his loans that he has, his performing ones and his non-performing ones, his policy portfolio, and really exactly how we're incorporating this into our own lives. Because, hey, we're here, we're all walking down the road together. What I like to say, the wealth train is going to keep on moving down the tracks, and it's your responsibility to show up at the station, to hop on and get on, or you can keep living the life how you are. It don't matter. I mean, that's the freedom of what we have here in America. You can go and live and be whoever you want, but in my opinion, I think having money, it's not so much about the money, it's more about the lifestyle. I want to have a lifestyle that my pocketbook is not being dictated on how I spend my time, my location at. And this is why I'm able to go to Acapulco, Mexico for a week and not answer calls. Literally next week, I'm about to go down to the Florida Keys with my family. It's lobster diving season, baby. So we're going to go and dive for lobsters. I personally won't be. My two brothers love to do it, but I'm going to be sitting my boat on the boat and getting a suntan, reading my book. But this is what allows me to have the freedom of my time and my location, is because I truly understand money, the psychology of money, and not letting that new shiny object come in inferior with what I already have going on. And that's going to be one of my upcoming episodes, is the shiny object syndrome. Okay, so thank you for tuning in to today's episode. I really do appreciate y'all. I will be back next week because we are back at it, baby. If you're still on audio, you're not seeing me dance right now, so you should truly be on the YouTube channel for it. But reminder, okay, if you've stuck around all the way to the end, if you go to themoneymultiplier.com/mastermind 2025, I will share with y'all a discount code for the mastermind event. So send me an email, podcast@themoneymultiplier.com. I have a 15% off discount code that you can use at checkout. And I hope to see you in Denver. Seriously, I'm going to have the insurance companies there. I'm going to do a live insurance company panel. We're going to get into live case studies. We're going to discuss my dreamers, the builders. You can really meet the team in person and see who's here behind you on the same path to financial freedom. So until next week, I will see y'all then. I love y'all. Thanks for being here. And I'm so excited to be back, y'all. So catch me every single week on Tuesdays. And leave a comment down below. Give this podcast 5-star rating. Let me know your thoughts. I want to know questions. I want to know topics. I want to know different guests that you want to bring onto this channel for me to interview. And until next time, Money Multipliers, I'll see you then. Mwah! Bye, y'all. Hey, y'all. Thanks for tuning in to another episode. If you enjoyed this content and you want to check out last week's episode, click right here and it'll take you to the previous week. So thanks for tuning in. I will see y'all next Tuesday. Catch you then.